So um, first, let me give you the example or a little bit of history of what happened with us, with myself and Konstantin, my business partner, in our evolution as physical therapy practices. We opened our first physical therapy practice in 1992. So that was 31 years ago. And that was actually in Queens, and then a satellite office in Manhattan. And from 1992 to 1998, in 6 years, we went from one PT practice to 13 physical therapy practices, treating more than 3,000 visits per week. So we had a very, we were opening two or more practices per year. We had a very, very fast growth, and it was great. What ended up happening from 2002 to 2004, a tremendous change happened in the state of New York. Insurances slashed their rates to more than 50%. New York became the laboratory of testing how low an insurer can go before they hit bottom on the level of tolerance of physical therapy practices. So just to give you some examples, and I know, for example, that Daniel is practicing in New York right now. Daniel, back in the mid and late 1990s, we used to get paid from Blue Cross Blue Shield $140 to $160 a visit in New York. And right now, as you know, you don't get paid more than around $60 a visit from Blue Cross. This is a change that happened in 2002. So we went like from, I call this the letter that changed everything. In November of 2002, we received just a few days before Thanksgiving, a letter. Was the first one, I think it was from Blue Cross, that it was an ultimatum that unless we accept the new rate, which was from $140 down to $60 on January 1st, we would have to leave the panel. They would cancel our participation. A couple of months later, we received similar letters. Aetna from $112 down to $60, $65. Oxford, United Healthcare from $88 back then to $62.50. So there were tremendous reductions in reimbursement. So we had to make very quickly changes. And those of you who have more than one locations and more than a few employees, you know that the larger you become, the slower you can adapt, the slower you can incorporate changes throughout your organization. So it was very, very difficult. I mean, how do you slash personnel or expenses so drastically, especially when you have back then, more than $250,000 payroll every 2 weeks. So, and 150 something employees. So it was very challenging. We overcame this. In many different ways. Initially, we overcame this by selling some of our locations, and also by consolidating some others to reduce expense, because it was, if all of a sudden your income gets slashed by 40%, it's such a huge reduction that you have to really move fast to survive. And then, I mean, for us, the saving grace was that we realized that um, the very, very few cases of diagnostic testing that we were doing back then, EMGs, not yet ultrasounds, we were doing mostly EMGs back in the mid 1990s. The reimbursement was wonderful. So when this happened with insurances, our level of necessity increased, and we started paying more attention to that side of the business. And we developed then, little by little, a very robust, very successful diagnostic testing business with profit margins in the neighborhood of 40% or more. So, and this is our story back then, right? But they say history repeats itself. And what you see right now is you see tremendous reductions in reimbursement rates from insurances. And Daniel, I don't know, I'm referring to you because you are in New York. Today, I received 2 text messages from colleagues in New York that they received a letter from health.
Health.
Okay, so talk to me about that. What did you receive?
So we don't take them, but my colleague, he came into work this week and he sent me a picture. They slashed it to $50.
That's right.
Yeah.
From right now, practices get more than $100 and something, right?
Right.
Now, how can a practice survive like that, right? I mean, how can a practice survive when rates get slashed, when rates get reduced from $110 down to $50 a visit? So that can be extremely challenging. Anamon, hello and welcome.